once again, we've got gold up 1% today, rallied on the back of J-Powell yesterday. Bonds got a bid too. It's like the market still thinks there's a Fed put. So does it make sense to you?
Well, I mean, to be honest, the market has been using the Fed to motivate narratives for a long time, most of which don't ever materialize. Usually the Fed is a catalytic point for the market repositioning. We get too skewed in a particular story in one direction, and then the Fed forces us to rethink whether or not that direction was wise. And I think that's been happening here. If you look back over the past few months, maybe even longer, the narrative has been there's a dollar shortage, there's a dollar squeeze, the dollar's strong, and it's going to hurt us. And I think the positioning just got a little bit too skewed. You could see this in the patterns for gold starting about 2 days ago, and a couple of other assets. So this narrative will play out. But I really don't think, the one way or the other the Fed is doing anything. They're just kind of in a holding pattern, saying we'd like inflation to be a little bit higher to fulfill our mandate. But we don't want to cut rates either because we think the economy is in a fairly solid place. We're not growing great, but it's solid, right? It's kind of a 2% growth kind of thing. Now that the fiscal stimulus of a couple of years ago has rolled off.
So, Mark, if it's a narrative that doesn't necessarily, check out, the market for gold has been basically a little bit more of a swinging market, but still very similar to that in the treasuries as well. Earlier this year, they traded basically at a correlation of 0.9 for much of the summer as this kind of bunker trade, happened, and people were paranoid about geopolitics and the financial system flipping on its head and buying Bitcoin and stuff. So are we in for a corrective action for treasuries if there's a corrective action for gold?
I don't think that's the right way to look at it. I think gold has been the slave to bonds, and it's not that bonds have been driving. Bonds have been driven by gold. So gold has kind of been tracking the bond story tick for tick, and the bond story has been tracking all these other things. So I don't think it's an indicator of anything imminent, kind of a doom or gloom. It's really bad. So gold, kind of the way gold trades. I'm a long-term gold skeptic because I think it's no longer, it's no longer a monetary instrument. It hasn't been for 50 years now. But a lot of people are attached to it psychologically because they think it's going to protect them for something. So in moments of stress, there's still a bid that goes into gold. Extreme stress, there's still a bid that goes into gold. Now, each time that bid is a little bit less strong as new generations kind of come in. They go, what is this gold thing? And the people who remember their grandparents escaping from who knows where with a bar of gold, they die off, right? But that's still there. But when you don't have those extreme moments, what you see is a very strong relationship between real yields typically or bond yields, nominal even, and gold. So that's really what's happening. We're in a phase where people were positioned for a stronger dollar, probably too much, and now we're repositioning, and currencies are rallying, and bonds and gold correlates to that. Gold is going to follow bonds. Really, it's going to follow bonds.
So let's talk bonds here because there still seems to be a lot of resilience within the Treasury market. We've had bond yields turn around. We've had the world stabilization through PMIs starting to look pretty compelling. Our employment situation is monstrous here still from what we can see, Mark. And yet on days like yesterday and today, we've got a little bit of bond, weakness this morning. But there seems to be this idea that the Fed put and the central bank put is in play. We just heard from ECB. They're on hold too, but yet all these fund managers that come on my show, Mark, all the time, they're very long duration. They still have an idea that I guess things are going to get worse. So how do we, marry these two things together?
Yeah, I think the whole Fed put thing is overplayed. Obviously, again, it's a narrative that fits a lot of people's priors. People have been for years now over forecasting bearish outcomes, and when they're wrong, they say, "Well, if not for the Fed, I would have been right." So just look at when people talk about monetary policy and Fed put, just look back at what they've been saying over the past 10 years and whether or not they've kind of been on the right side of things. Because I think the serial error has been in over forecasting policy errors from the Fed. Now, when it comes to bonds, I think specifically, I think really what's going on is there's an asset shortage. There's a shortage in safe assets. So after the crisis, remember before the crisis, people were packaging all kinds of crazy instruments and labeling them AAA, and people could hold those to fulfill their capital requirements, their liquidity requirements. And now what's happened is there are fewer of those because you can't make AAAs in the same way, but the demand is much higher because banks have to reserve to a much greater degree than was ever the case before. At the same time, you have demographic changes that are increasing the demand for bonds, the demand for duration, and you have what we call financial deepening. So, all around the world now, particularly in the less developed countries, but everywhere, you have insurance companies and all kinds of people that have a structural demand for duration.
Right.
And even in a place like Brazil, where you didn't have an asset management industry to speak of 20 years ago, or an insurance industry, they have demand not just for Brazilian assets, but also for treasuries to some degree. So this keeps growing. And it's that fundamental imbalance that keeps the bid to bonds. So what I like to say is that the changes in yields tell you about what people think. The delta on yield tells you what people are thinking short term about economic outlook. But the level doesn't really give us much information at all because that's driven primarily by this fundamental imbalance.
I think
there's just a shortage of safe assets. And people are asking for duration. Just look at guys, like BlackRock's Rick Reeder, or listen to the guys at PIMCO. They tell you they need to have duration. So the pool of price-insensitive buyers continues to grow, right? And that's a much bigger factor. People still want to tie the level of bond yields way too tightly to fundamentals in the economy. There's the old rule of thumb where people would say it should be 10-year yield should be nominal GDP growth in the U.S. It's not that anymore because there are all these international and fundamental technical structural forces that are driving demand for bonds.
That structural demand for bonds that you describe sounds to me as a good explanation for why the elevation of yields could remain, a low one. But in terms of the rate of change, when there's a lot that's happening in the stock market too, there's still a lot of duration exposure there that I see, Mark, for flows and positioning in bond proxies, in low vol factor styles as well. Should we, though, be wary of some impetus for a shock surprise in terms of positivity? Let's say there's a trade deal. There's a lot of folks I talk to that don't really have any risk management strategy around a trade deal except saying, hey, we don't think one's going to happen. But if it does, is there going to have to be a steep corrective action in bonds, and does it have potential to bleed out elsewhere?
So the way I tend to look at these things, Oliver, is our reaction to an event depends on our positioning going into it.
Right.
As we saw with the taper tantrum, as we've seen a couple of other times, there can be, we've seen partial unwinds of the risk parity trade. They're always, last year we saw, or earlier this year we saw people getting really, really excited about bonds and getting overpositioned and getting and getting their.
You think we've worked that off?
This slept. I think most of it, yeah. So we're not as extreme as we were, but there could always be a bump in the road. That could always happen. I just don't see the positioning being extreme as was the case some months ago. Okay. But so the structural demand and the backdrop kind of dominates and mitigates these things. So I'm not really worried that there's going to be some kind of trade deal or some positive news event and yields are going to go higher, and then the world is going to collapse because people are improperly positioned. Like the taper tantrum, I don't think we'll see anything as dramatic as that, but we could see an echo taper tantrum. In fact, we've seen a couple since then. So that kind of thing can happen. But I don't think I think fundamentally we're in a low yield world, right? We're not going. It's been a slow process of realization for a lot of people that we're not going back to a Fed funds rate, an equilibrium Fed funds rate of 5%.
Right.
That's just not happening. We're not in that world anymore, and there are a lot of reasons I've written about as to why, from demography, credit tailwinds to credit headwinds, et cetera, et cetera. But people are coming around to this view that, and Powell was even talking about it yesterday. Like I said, I was writing about this in 2009. That world is gone, and we're in a slower growth world with a fair amount of debt on the planet. So I don't think we're going to collapse, but it's kind of an overhang, a dampener for economic growth. So the world is kind of, the U.S. is not growing at 3% anymore. We're growing at 2%. Europe is growing at 1% instead of 2%. China's ratcheting down its growth rate for demographic reasons primarily, but other reasons as well. And a lot of the world has kind of a debt cloud over it. Doesn't mean that we're going to collapse. but it does mean that it's going to be a governor for the speed rate, a rate of speed, so we're probably just going to have a muddling through process with low rates of interest and low rates of growth.
Yeah, Mark, hey, real quick before we let you go, if possible, a brutal question to do in 30 seconds, but should we be freaking out about the repo stuff? Still going on. Balance sheet is reversing from the end of last year.
Yeah, no, we shouldn't. I mean, if you want to freak out on repo, you're making the following bet, that the Fed doesn't know what the problem is and can't address it, right? It's really, so there's a really good podcast. I'll turn people, I wrote a thing about repo. You can see it on my blog, on the Behavioral Macro blog. But there's a great podcast that David Beckworth did with Bill Nelson. Just Google David Beckworth and Bill Nelson. Bill Nelson was an expert in these issues at the Fed, and he walks you through the reasons why people are kind of hoarding reserves. It's not that there are not enough reserves in the system. There are a lot of regulatory reasons and some psychological reasons, behavioral reasons why they're kind of hanging on to them, and that's squeezing repo.
Right.
It's really worth a listen for people who are afraid of the repo issues. There are going to be these pressures, but I think the Fed is going to be able to handle it.